Here is something that happens constantly in Canadian investing. Someone decides they want to start investing. They open a brokerage account. They do the right things. And then they spend the next 3 months reading Reddit threads, comparing XEQT versus VEQT, watching YouTube videos about whether 0.04% in MER is meaningful over 30 years, building spreadsheets comparing the Canadian equity allocation of 6 different all-in-one ETFs, and ultimately still not investing. Meanwhile, the market is going up without them. The all-in-one ETF decision is one of the least complicated decisions in personal finance. There are genuinely good options. They are all cheap, diversified, automatically rebalanced, and available commission-free at most Canadian discount brokerages. The meaningful decision, the one that actually determines outcomes, is not which one you pick. It is whether you pick one, contribute to it consistently, and leave it alone. This video covers what all-in-one ETFs actually are and why they represent one of the most significant advances in personal finance in a generation. The one number that makes the urgency of this decision clear, how to choose between the 4 tiers based on your actual situation, the XEQT versus VEQT debate that generates enormous amounts of internet heat for a 0.04% difference in fees, and the Canadian account and brokerage setup that makes the whole thing work. By the end of this video, you will know exactly which ETF to buy and why, and you will never need to read another comparison article again. Before all-in-one ETFs existed, building a properly diversified investment portfolio required either paying a financial advisor 1% to 2% per year to manage it, buying a mutual fund that charged similar fees and often delivered worse results, or manually purchasing multiple individual ETFs, Canadian equity, U.S. equity, international equity, bonds, and rebalancing them periodically yourself. Each of these had friction, cost, time, knowledge required, and the ongoing decision-making burden of maintaining the allocation over time. An all-in-one ETF eliminates all of that friction in a single product. What you get when you buy 1 unit of XEQT, you instantly own a proportional share of approximately 9,400 companies across Canada, the United States, international developed markets, and emerging markets, all in a single trade. The fund holds 4 underlying ETFs, iShares Core S and P Total US Stock Market ETF, 45% of the portfolio, iShares Core MSCI EAFE Index ETF, approximately 25% international, iShares Core MSCI Canadian Quality Dividend Index ETF, approximately 25% Canadian, and iShares Core MSCI Emerging Markets IMI Index ETF, approximately 5% emerging. Every quarter, when these underlying allocations drift due to market movements, the fund rebalances automatically. No action required from you. The MER, the annual cost of holding this. XEQT charges a management expense ratio of 0.20% per year. On $10,000, that is $20 per year. On $100,000, that is $200 per year. This fee comes silently out of the fund's returns. No invoice, no transaction, just a slightly lower return than the gross market return. For comparison, the average Canadian actively managed mutual fund charges approximately 1.5% to 2.5% per year, between 7 and 12 times the cost of XEQT. Why automatic rebalancing is more valuable than most investors realize. When equity markets rise strongly and bonds stay flat, the equity allocation drifts above its target. When markets fall, bonds hold value better, and the equity allocation drops below target. Rebalancing, selling some of what has risen, buying more of what has fallen, is how a portfolio maintains its intended risk level and, over time, captures a modest return premium from buying low and selling high systematically. Doing this manually across multiple ETF positions requires paying attention, making decisions, and doing trades. An all-in-one ETF does it internally, automatically, at no additional cost. The specific reason this is revolutionary for Canadians: before these products existed, the portfolio that a sophisticated institutional investor would build, globally diversified, low-cost, automatically rebalanced, was practically inaccessible to most retail investors without significant expertise or professional fees. A single $50 contribution to XEQT buys the same globally diversified, automatically rebalanced portfolio that a $10 million institutional investor holds. The all-in-one ETF democratized something that was previously only available to people with very large portfolios or very expensive advisors. Here is the vault, the one number that makes the urgency of switching from a typical Canadian bank investment product to an all-in-one ETF completely clear. The fee gap made specific. A typical Canadian bank-sold balanced mutual fund charges approximately 2.0% MER per year. A comparable all-in-one ETF, XBAL or VBAL, at 60% equity, 40% bonds, charges approximately 0.17% to 0.20% MER. The difference, approximately 1.80 to 1.83 percentage points per year. On a $200,000 portfolio held for 25 years at a 7% gross annual return, that fee difference compounds into a difference of over $200,000 in final wealth. And at a $200,000 starting balance with no additional contributions, the gap in this table reaches approximately $334,000 by year 25. This is the number that should end the debate about whether it is worth opening a discount brokerage account, learning to buy an ETF, and leaving behind a bank mutual fund. The bank is not providing $334,000 of value in research, management, and oversight relative to a passively managed, automatically rebalanced index ETF. The research on active versus passive management is clear and consistent over decades. Most actively managed funds do not beat their benchmark index net of fees over long time periods, and the ones that do cannot be reliably identified in advance. Why most Canadians are still in mutual funds: convenience, inertia, and the distribution model of Canadian banking. Walk into a bank branch and ask where to invest your savings. A mutual fund is the answer you receive, because that is the product the bank sells and earns a trailer fee from. The all-in-one ETF is not sold in bank branches. It is purchased through a discount brokerage account, which requires opening an account, finding the ticker symbol, and placing a trade. This is 30 minutes of one-time setup. The financial benefit, compounded over 25 years, is approximately $334,000 on a $200,000 portfolio. The setup is not complicated. The fee gap is. Here are the 4 tiers of all-in-one ETFs available to Canadian investors, with the specific reason each tier exists and the specific investor it is designed for. The full all-in-one ETF lineup. Tier 1. 100% equity. XEQT, VEQT, ZEQT. These are for investors with a long time horizon, ideally 10 or more years, who are comfortable with the knowledge that in a severe market downturn, the portfolio can fall 30% to 40% and will need time to recover. A 100% equity portfolio has historically delivered the highest long-run total return. It is also the most volatile, meaning the most emotionally challenging to hold through downturns without selling. A 100% equity fund like XEQT or VEQT can fall 30% to 40% in a severe market downturn, but historically recovers and delivers the highest long-run return. It suits a long horizon of 10+ years and an investor who will not sell in a panic. The honest test for whether you belong in this tier: if a 35% paper loss on your portfolio would make you sell, regardless of your age or stated time horizon, you are not a 100% equity investor. The worst thing you can do with a 100% equity ETF is sell during the exact downturn it is designed to hold through. Tier 2. 80/20. Growth. XGRO, VGRO. 80% equities, 20% bonds. The bond allocation does not dramatically smooth returns in a major crash. Bonds are only 20% of the portfolio, which limits their stabilizing effect. But they take the edge off day-to-day volatility, give the fund something to rebalance into when equities fall, and provide a psychological anchor for investors who know themselves well enough to know they will check their portfolio during a downturn. For investors within 10 to 15 years of retirement, or anyone who experienced 2020 and made a decision they regret, the ballast in XGRO is genuinely useful. Same cost as XEQT at 0.20% for iShares. Slightly higher at 0.24% for Vanguard's VGRO. Tier 3, 60/40. Balanced, XBAL, VBAL. 60% equities, 40% bonds. The most conservative all-in-one option on this list, with shallower drawdowns and lower long-run expected returns. A 60/40 balanced fund like XBAL or VBAL suits investors close to or in retirement, or anyone who has discovered they cannot tolerate watching the balance drop. VBAL has a slight MER advantage at 0.17% versus XBAL at 0.20%. For a balanced investor where the bond allocation is meaningful, the Vanguard version wins on fee. The allocation choice in practice. The equity-to-bond split is the primary driver of how much your portfolio falls in a bad year. It should be determined by your time horizon and your actual tolerance for watching the number go down, not by what sounds reasonable in a good market. The specific question to ask: if my portfolio fell 30% tomorrow and stayed there for 2 years, would I keep contributing automatically, or would I sell? If the honest answer is, I would probably sell, you are not in the right tier. Let's address the debate that generates more Reddit heat, more YouTube videos, and more paralysis than any other question in Canadian ETF investing: XEQT versus VEQT. Here is the honest answer. The difference between XEQT and VEQT over 30 years is rounding error. If you have strong Vanguard loyalty, VEQT is a perfectly reasonable choice. Just pick one and stop thinking about it. The actual differences between XEQT and VEQT are these: MER, XEQT 0.20%, VEQT 0.24%. Difference, 0.04%. On $10,000, that is $4 per year. On $100,000, $40 per year. Over 30 years at 7% return, the MER difference compounds to approximately $3,800 on a $100,000 portfolio. Real, but not the $334,000 that separates both from a bank mutual fund. Canadian equity allocation XEQT holds approximately 25% Canadian equities. VEQT holds approximately 30% Canadian equities. If you have a strong view that Canadian stocks will outperform global stocks over your investment horizon, VEQT's higher Canadian tilt is the differentiating factor. Most investors should not have a strong view on this. Emerging markets allocation, XEQT, holds approximately 5% emerging markets. VEQT holds approximately 8%. If you want more emerging markets exposure, VEQT delivers it. Everything else, virtually identical. Both are globally diversified. Both are automatically rebalanced. Both are available commission-free at major discount brokerages. Both hold thousands of underlying securities. XEQT and VEQT are so similar that any performance difference between them is noise, not signal. Pick based on your allocation preference and fee sensitivity, not recent returns. MM's direct recommendation: if you are starting fresh and have no institutional preference, buy XEQT. Lower MER, slightly more global diversification. If you prefer Vanguard as a provider or want a slightly higher Canadian equity weight, buy VEQT. Both are excellent. The decision between them is genuinely the least important decision in your investing life. Make it in the next 5 minutes and move on. The ZEQT consideration. BMO's ZEQT offers a 100% equity all-in-one at 0.20% MER, the same cost as XEQT. It is a solid product. It has lower assets under management than XEQT and VEQT, which is not a deal-breaker but is worth noting. If you bank with BMO and use their discount brokerage, ZEQT is a perfectly reasonable choice. If you do not have a specific reason to prefer BMO, XEQT, or VEQT are better established products with larger asset bases. Let's come back to where we started. Someone decides to start investing. They open a brokerage account. They do the right things, and then they spend 3 months reading comparison articles and Reddit threads and still haven't bought anything. Here is what those 3 months of research should have produced, and what this video just gave you in 12 minutes. 1 fund. Pick the tier that matches your time horizon and your actual risk tolerance. 100% equity if you have 10+ years and will not panic sell. 80/20 if you're within 10 to 15 years of needing the money or know yourself well enough to want a cushion. 60/40 if you are near retirement or cannot watch a 30% drop without selling. Within the 100% equity tier, XEQT at 0.20% AEMER or VEQT at 0.24% MER. The difference over 30 years is approximately $3,800 on $100,000. Both are vastly better than the bank mutual fund charging 2.0%, where the gap over 25 years is $334,000. Pick one. Both are fine. Hold it in a TFSA for most Canadians. Buy it commission-free at Questrade or Wealthsimple. Set up automatic monthly contributions on payday. Leave it alone. That is the answer the internet has been hiding behind 47 comparison articles. It fits in 4 sentences. Go invest.